Michael Saylor just triggered a $216 million move that most people are calling a sell-off, but it's actually a legal financial cheat code to dominate the Bitcoin market.
Exactly. And while he plays the infinite money glitch, housing expert Nick Gerli warns that the mortgage market is hitting delinquency levels worse than the 2008 crash.
We have condensed hours of deep dive analysis from titans like Saylor, technical master Matt deWolf, and macro strategist Jeff Snider into this high-speed AI summary.
We're cutting through the noise to show you why NVDA's $120 level is the only number that matters today, and how European banks are facing a hidden liquidity tax.
Stick around to see why the pros are fleeing the digital casino for an asset your grandmother likely owns. It's time to find out what the big money knows that you don't. Today, we're dissecting Michael Saylor's massive move, selling $216 million of his MicroStrategy shares to buy more Bitcoin.
George Gammon pointed out that while Saylor sold sounds like a panic move, it's actually a strategic rebalancing into personal Bitcoin holdings.
Wait, hold on. Isn't Michael Saylor the never sell guy? Why is he dumping stock now?
He's selling the company stock, not the Bitcoin itself. He's effectively trading his equity for the underlying asset.
So instead of owning the company that owns the Bitcoin, he's just owning the Bitcoin directly.
Got it. So it's a bet on Bitcoin, just in a different pocket.
George Gammon's discussion highlighted how MicroStrategy trades at a premium to its actual Bitcoin holdings.
Exactly. If the stock is worth more than the Bitcoin it holds, Saylor can issue more stock, buy more Bitcoin, and repeat the cycle.
Is that even legal? Sounds like a financial cheat code.
It's perfectly legal. It's what Gammon calls the infinite money glitch, as long as the stock premium stays high.
But if that premium disappears, the whole house of cards could get shaky.
So if people stop overpaying for the stock, the glitch breaks?
Saylor believes the arrival of spot Bitcoin ETFs from giants like BlackRock and Fidelity is a game changer.
It opens the floodgates for institutional capital that couldn't buy Bitcoin directly before.
Wait, so now my grandma's pension fund could be buying Bitcoin through BlackRock?
Essentially, yes. It turns Bitcoin into a standard asset class like gold or tech stocks.
George Gammon notes this adds massive demand, but it also means more oversight.
More money, more problems, right?
Michael Saylor has turned MicroStrategy into a Bitcoin fortress, holding over 189,000 Bitcoins.
That's a massive concentration of risk. If Bitcoin drops 50%, what happens to the company?
189,000. That's more than most countries have.
It is, but Saylor's analysis suggests the upside of Bitcoin's scarcity outweighs the volatility risk.
Gammon is more skeptical, focusing on how debt service becomes an issue during a bear market.
So Saylor is the bull, and George is the guy checking the brakes.
Saylor's whole thesis rests on the fact that there will only ever be 21 million Bitcoins.
He views it as the only pristine collateral in a world where central banks print trillions of dollars.
So Bitcoin is basically digital gold that nobody can print more of.
Exactly. In Michael Saylor's view, everything else is eventually debased by inflation.
But George Gammon reminds us that price isn't the same as value. Market psychology can be brutal.
Right, because if nobody wants the digital gold, the price still goes to zero.
Saylor's projections see Bitcoin hitting 6 figures easily as institutional adoption scales.
If the spot ETFs keep pulling in billions, the supply-demand imbalance could force a massive price spike.
$100,000? That would make my 1/10 of a Bitcoin look pretty good.
It would. But remember, Saylor is looking at a 10-year horizon, not next week.
And George Gammon warns that a broader economic recession could still drag everything down first.
So, moon mission. But we might hit some turbulence on takeoff.
There is a dark side. George Gammon points out that MicroStrategy has used debt to buy Bitcoin.
If the price falls toward $30,000, the margin calls and interest payments become a major stress test.
Wait, what's a margin call? Does that mean they lose everything?
It means the lenders want their money back. If Saylor can't pay, he might be forced to sell the Bitcoin he promised to never touch.
That's the black swan event George is watching for.
Suddenly that infinite money glitch sounds a lot riskier.
Michael Saylor suggests the single most important metric now is ETF net inflows.
If the big players like BlackRock are buying, it provides a price floor.
So I should be checking the news for how much Wall Street is buying every day.
Basically, it's the best indicator of institutional sentiment.
George Gammon also says to watch the premium on MicroStrategy stock.
When the premium gets too high, it usually means the market is overextended and a correction is coming.
So if people are paying way too much for the stock compared to the Bitcoin, I should be careful.
That's the takeaway. Don't get caught in the hype when the glitch is redlining.
Got it. Keep one eye on the Bitcoin and one eye on the exit.
Today, we're breaking down the latest market moves through the lens of Matt deWolf, the voice behind Trade Brigade's technical analysis.
Matt is all over the pre-market prep today, specifically looking at how the labor data is clashing with a massive surge in semiconductors.
Wait, Matt from Trade Brigade? Is he the one who's always charting those ripping stocks?
That's the one. He's tracking the ADP non-farm payroll reaction as it happens, and the results are pretty surprising. The big reveal from Matt deWolf's analysis is that ADP private payrolls hit 143,000, easily beating the 128,000 estimate.
Exactly, it's the Goldilocks number. While that labor data settles, Matt points out that semiconductors are absolutely ripping right now.
Hold on, 143,000 jobs. Is that supposed to be good or bad for my tech stocks?
According to Matt, it's good because it shows resilience without being so hot that it forces the Fed to hike rates.
But don't get too comfortable. Matt also notes that while SockSell is soaring, the broader market is still digesting these labor figures.
So the alpha here is that chips are flying, even if the rest of the market is confused.
Matt deWolf highlights that SockSell, the triple-leveraged semi-ETF, is seeing a massive push higher.
It's all about NVDA and AMD. Matt's charts show them breaking through key resistance levels early in the session.
Wait, triple leveraged? Isn't that super risky for a normal person?
It's definitely volatile, but Matt's point is that the momentum is so strong it's dragging the whole tech sector up with it.
He specifically mentioned NVDA holding its ground while others struggled.
So if NVDA stays green, the whole party keeps going.
Matt deWolf is closely watching NVDA at that $120 mark. It's a psychological and technical line in the sand.
Right? And Matt noted that as long as we stay above that, the bulls remain in control of the narrative.
$120? That seems like a random number.
In technical analysis, those round numbers often act as major support. Matt sees a lot of buy orders sitting right there.
But if it dips below, Matt warns we could see a quick slide back to the low 100s.
Okay, so 120 is the magic number to watch on my screen.
Matt deWolf also flagged AMD as a potential catch-up play if it can break out of its current range.
Yeah, while NVDA has been the star, AMD has been consolidating. Matt thinks a breakout is brewing.
Breakout, like a skin condition.
No, a price breakout. It means the stock is finally moving past a level it's been stuck at for weeks.
Matt is looking for AMD to follow the leader. If the sector is ripping, AMD usually isn't far behind.
Got it. So buy the one that hasn't blasted off yet. Hopefully.
Matt deWolf predicts that this stronger than expected ADP data makes a 50 basis point rate cut much less likely.
Exactly. We're probably looking at a quarter-point cut now, which Matt says is actually better for market stability.
Wait, a smaller cut is better. Wouldn't I want more free money from the Fed?
Matt's logic is that a huge cut looks like a panic move. A small cut says the economy is fine, we're just adjusting.
So, Matt thinks the Goldilocks scenario keeps the bulls happy for the rest of the month.
So no panic, just vibes and slow cuts. I can live with that.
Despite the current rip, Matt deWolf warns that semiconductors are heading straight into major overhead resistance.
He's eyeing the recent highs in SockSell. If it can't clear those, we might see a double top and a sharp reversal.
Double top? That sounds like a burger order.
It's a bearish pattern. It means the stock tried to go higher twice and failed both times.
Matt's prediction is a brief cooling off period before we see if the bulls have enough gas for a real breakout.
So don't chase the rally at the very top. Note taken.
Matt deWolf's main takeaway is to keep a laser focus on that $120 level for NVDA.
If it holds, you're looking at a continued tech rally. If it breaks, tighten your stop losses.
So if NVDA drops below 120, I should probably stop checking my portfolio for a few days.
According to Matt, that's when the risk-to-reward ratio shifts against you. Finally, Matt says to watch SockSell for signs that the move is getting overextended or exhausted.
He's looking at the RSI, the Relative Strength Index, to see if the buying has become too frenzied.
Wait, so if everyone is buying at once, that's actually a bad thing?
In Matt's world, yes. It usually means the smart money is getting ready to sell to the latecomers.
So stay alert, watch those levels, and don't get blinded by the green candles.
Got it, no FOMO, just charts. Thanks, Matt.
The era of big tech dominance is hitting a wall. Thomas Hayes, the chairman of Great Hill Capital, says we are on the verge of the great rotation.
Exactly. Thomas believes the money is about to flood out of the overextended tech giants and into the forgotten corners of the market.
Wait, rotation? Are we just moving money from one pocket to the other? Or is this a complete closet cleanout?
Think of it as the market finally realizing that other stocks exist besides the Magnificent Seven.
Thomas notes that this isn't just a trend, it's a structural shift triggered by the Fed's next move.
The alpha here is simple. Thomas Hayes is betting big on small caps as interest rates start to cool off.
His analysis shows that smaller companies are far more sensitive to rates. When the Fed cuts, these stocks breathe again.
Hold on, why do smaller companies care more about rates than, say, Apple?
Because they often have more floating rate debt. Lower rates mean their interest payments drop instantly, boosting the bottom line.
So while tech is priced for perfection, small caps are priced for a disaster that might not happen.
So it's like a discount sale for the rest of the stock market.
David Lin's discussion with Thomas highlighted that earnings growth is finally broadening out.
For the last year, It was just the Magnificent Seven doing the heavy lifting, but now the other 493 companies are catching up.
Wait, 493? That's basically the entire stock market finally showing up to work.
Pretty much. Thomas points out that when earnings growth accelerates for the average company, the index follows suit.
But if everyone is growing, doesn't that just mean inflation is back?
Not necessarily. It means the recovery is becoming more balanced across different sectors.
Let's look at the numbers. Thomas Hayes notes that tech is trading at a 30 times price-to-earnings ratio.
Meanwhile, small caps are sitting at roughly 15 times. That's a massive 50% discount.
Wait, 50%. So I can buy 2 small cap companies for the price of 1 tech stock.
In terms of earnings power, yes. That valuation gap is what Thomas calls a once-in-a-decade opportunity.
But there's a reason they are cheap, right? They aren't all NVIDIA.
Right, but at half price, do they even need to be NVIDIA to make me money?
Thomas isn't just talking about generic small caps. He's looking at specific laggards like biotech and financials.
Exactly. These sectors have been under pressure from high rates, but the data suggests they're bottoming out.
Biotech? Isn't that super risky? Like one bad lab result and your money vanishes?
Usually yes, but when the whole sector is depressed, even decent news can send stocks soaring.
Thomas suggests that as the cost of capital drops, these capital-intensive industries become the new favorites.
So the boring stocks are finally having their day in the sun.
What's the price target? Thomas Hayes is looking at a 15 to 20% surge for the Russell 2000.
He expects this to happen as the market prepares for the first rate cut in September.
20%? That would be a huge move for a broad index.
It is, but remember, it's coming off a very low base while the S&P is at all-time highs.
Thomas believes the momentum is shifting and the catch-up trade is just beginning.
So I shouldn't wait until the Fed actually cuts to get in.
On the flip side, Thomas warns that the extreme concentration in tech creates a 5 to 10% pullback risk.
If everyone is crowded into the same 5 stocks, the exit door is very small when people start selling.
So if big tech slips, does the whole market go down, or does the money just move?
That's the rotation part. The indices might stay flat, but underneath the surface there's a massive reshuffle.
So it's not a crash, it's a transition.
I hope my portfolio knows how to dance then.
Thomas Hayes suggests watching the IWM ticker very closely right now.
That's the Russell 2000 ETF. A breakout above its recent range would confirm the Great Rotation is in full swing.
Got it. So if that line goes up, the rotation is real?
Exactly. It's the litmus test for Thomas's thesis. Finally, the advice is to rebalance. Don't be 90% weighted in just 3 tech stocks.
According to Thomas, diversifying into value and small caps provides a safety net if tech finally tires out.
So basically, stop putting all my eggs in the AI basket.
Exactly. The AI basket is full. It's time to find some other baskets.
Smart moves. Thanks for the breakdown. The mortgage market is officially cracking. Nick Gerli reports that FHA delinquency rates just hit 11%, the highest level we've seen in nearly 40 years.
It's a massive red flag. Nick highlights that we are now surpassing the distress levels seen during the 2008 financial crisis in specific sectors.
Wait, 11%? That sounds like a lot of people aren't paying their bills. Is this 2008 all over again?
In some ways it's worse. Nick Gerli's analysis shows that while the broader market looks stable, the low-income and entry-level segments are under extreme pressure.
And it's not just the payments. Nick points out that inventory in places like Florida and Texas is exploding because no one can afford to buy.
Exactly. We're witnessing a massive shift where the lock-in effect is finally breaking under the weight of high interest rates.
So homes are sitting empty while people can't pay their mortgages. That's a bad combo.
It's a perfect storm. While the Sunbelt is the epicenter, Nick warns this contagion could spread nationwide shortly. Nick Gerli identifies a major shift. Non-bank lenders now control 70% of the mortgage market, and they don't have the same safety nets as big banks.
That's the alpha here. If these non-bank lenders see a wave of defaults, they don't have the cash reserves to survive, which could freeze the entire housing market.
Hold on. If they don't have the cash, what happens to the people who have mortgages with them?
The loans get sold off, often in fire sales, which Nick notes can lead to even more volatility in home prices.
So we're looking at a systemic risk that's mostly flying under the radar of the mainstream news.
Great. Another thing to stay awake at night worrying about.
Nick Gerli argues that the rise of the accidental landlord is about to flood the market with supply.
Right. People who bought during the pandemic to run Airbnbs are seeing revenues drop and are now looking for the exit.
Wait, so all those vacation rentals are going to become regular houses for sale again?
That's the theory. When you add that shadow inventory to the rising defaults Nick mentioned, supply could skyrocket.
And we know what happens when supply goes up and demand is dead.
Prices go down. Finally, some good news for those of us still renting.
Nick highlights a massive 35% gap between what people earn and what it costs to actually carry a mortgage today.
That gap is unsustainable. Nick's data shows that unless rates drop to 3%, which isn't happening, prices have to correct.
35%. I can barely afford eggs, let alone a 35% premium on a house.
Exactly. Nick's point is that the math simply doesn't work for the average American family anymore.
Which means the only way out is a significant price adjustment, likely starting in the most overvalued cities.
So the math is basically telling us the party is over.
Nick emphasizes that FHA loans are the canary in the coal mine because they represent the most vulnerable buyers.
When those default rates climb, it's usually only a matter of months before the conventional loan market starts to feel the heat.
So the FHA is like the early warning system for the rest of us.
Precisely. And right now, that warning system is screaming according to Nick's research.
It's the first domino. Once it falls, the rest of the housing market follows suit.
I'm starting to think I should keep my down payment in a high-yield savings account for a while.
Nick Gerli predicts a 15 to 20% drop in home prices across overvalued markets like Austin and Phoenix by 2025.
He bases this on the current inventory buildup and the lack of buyer demand at 7% mortgage rates.
20%. That would wipe out a lot of people's equity, wouldn't it?
For those who bought in the last 2 years, yes. They could end up underwater very quickly.
Nick warns that waiting for a pivot might be a losing strategy if you're holding high-priced real estate right now.
Wait, so the wait and see approach could actually be the most dangerous one?
Another prediction from Nick: foreclosure filings are expected to jump 30% year over year as pandemic protections fully expire.
We're already seeing the start of this in the latest court data. The grace period for struggling homeowners is over.
30% more foreclosures. That's going to put a lot of pressure on local economies.
It will, but it also provides the inventory that Nick says is necessary to bring prices back down to reality.
It's a painful process, but according to Nick, it's the only way the market resets.
A reset sounds good in theory, but the painful part sounds, well, painful.
Nick Gerli suggests keeping a very close eye on the Mortgage Bankers Association delinquency reports to catch the next wave early.
If you see those numbers rising in your local zip code, it's a signal that a price drop is imminent.
So I should be checking these reports, like I check the weather.
If you're looking to buy or sell, absolutely. It's the most reliable data set we have right now.
Finally, Nick recommends staying liquid. Cash is king when a market is searching for a floor.
Being able to jump on a distressed property deal in 12 months is better than being stuck in an underwater mortgage today.
So keep the cash in the bank and wait for the fire sale?
That's the takeaway from Nick Gerli's analysis. Patience is going to pay off in this cycle.
Patience. I can do that, especially if it means saving 6 figures on a house.
Smart move. The data doesn't lie, even when it's uncomfortable.
Jeff Snider is sounding the alarm on a massive shift inside European banks that most people completely missed. The European Central Bank just slashed the interest it pays on minimum reserves to 0%.
It sounds like a technical tweak, but Jeff Snider explains this effectively, wipes out billions of euros in easy profit that banks were counting on.
Wait, 0%? So the banks are just handing money to the central bank for free now?
Exactly. They used to get paid to hold those reserves, and Jeff says taking that away is like pulling the rug out from under their balance sheets.
While the headlines focus on interest rates, Jeff Snider's analysis reveals a much deeper problem. The plumbing of the global Eurodollar system is starting to leak.
Plumbing? Are we talking about banks or literal pipes?
It's the financial plumbing, how money moves between banks globally. If European banks are squeezed, the whole world feels the liquidity pinch.
And that's the alpha here. The stability of these banks is a mirage masking a massive credit contraction we'll break down in a second. Jeff Snider points out that this move by the ECB isn't just about policy, it's a direct hit to the bottom line, costing banks roughly 6 billion euros a year.
It ends the risk-free arbitrage where banks could just sit on cash and collect a check from the government.
6 billion. That's not just a tweak, that's a massive hole in the budget.
And Jeff's thesis is that when banks lose free money, they start taking fewer risks elsewhere, which means they stop lending to businesses and people like us. According to Jeff Snider, forcing banks to hold reserves at 0% interest is essentially a hidden tax on the entire financial system.
Right? Because that's capital they can't use for anything else. It's dead money.
Hold on. So the government is basically forcing banks to lend them money for free while we're all paying 5% on our mortgages.
That's exactly what Jeff is highlighting. It creates a massive imbalance that discourages banks from participating in the broader economy.
It's why we're seeing the WTF reaction from bank executives who weren't prepared for this level of aggression from the ECB.
Jeff Snider's data shows that bank lending in Europe is falling off a cliff, mirroring patterns we haven't seen since 2008.
It's not just that they don't want to lend, it's that they technically can't afford to, with their margins being squeezed from every side.
Wait, so is this 2008 all over again? Should I be worried about my savings?
Jeff isn't saying the banks will collapse tomorrow, but he is saying the money printer is effectively running in reverse right now.
When credit disappears, the economy grinds to a halt. That's the real danger Jeff is pointing to. One of the most complex parts of Jeff Snider's discussion is the shift from a floor system to a corridor system for interest rates.
In plain English, the ECB is trying to regain control over interest rates because they've lost their grip on how money actually moves between banks.
Wait, the people in charge of the money don't have control over the money. That's terrifying.
That's Jeff's point exactly. The central banks are reacting to the market rather than leading it.
They're changing the rules mid-game because the old ones aren't working anymore, and the banks are the ones bearing the cost.
Jeff Snider predicts a sharp economic downturn in Europe as banks tighten their belts. We're looking at a potential 15% drop in credit availability.
And without credit, businesses can't expand and consumers can't spend. It's a textbook recipe for a recession.
15%. That sounds like a lot of businesses going under.
It is. Jeff suggests the ECB's inflation fight might accidentally trigger a much deeper systemic crisis.
Another big prediction from Jeff Snider, the shortage of US dollars in the global system will get worse as European banks pull back.
Since most global trade happens in dollars, a dollar shortage makes everything more expensive and harder to trade.
So even though this is happening in Europe, it's going to make things more expensive here too.
Exactly. The Eurodollar system is global. If the pipes freeze in Frankfurt, the water stops flowing in New York.
Jeff Snider's top advice? Keep a very close eye on the Euribor spread. It's the fever thermometer for the banking system.
If that spread starts widening, it means banks don't trust each other. That's your cue to get defensive.
Okay, so spread goes up, things are blowing up. Got it.
Exactly. It's a leading indicator that's often way ahead of the news.
Based on Jeff's analysis, now is a risky time to be heavily invested in European bank stocks.
Because they're losing those 6 billion euros in profit, right?
Precisely. Their easy money era is over, and Jeff Snider thinks the market hasn't fully priced in the pain yet.
Keep your eyes on the data, not the central bank promises.
Today, we're dissecting a heavy conversation between Adam Taggart and Chris Irons, the mind behind Quote the Raven research.
Chris Irons doesn't hold back. He describes today's financial markets as a digital casino on cocaine.
Wait, did he actually say on cocaine? Is he talking about the brokers or the stock charts?
He's talking about the sheer frantic volatility and the total disconnect from reality we're seeing in the S&P 500.
Irons has built a reputation for spotting the structural rot that most analysts ignore while chasing the next pump.
Exactly. His analysis with Adam Taggart highlights why the current record highs might actually be the most dangerous trap in market history.
So, basically, the party is rocking, but Chris thinks the floor is about to cave in.
That's the alpha here. Irons believes we are witnessing a liquidity-driven delusion that's reaching its breaking point. Chris Irons argues that the market has abandoned value investing for pure gambling.
He points to the massive surge in Zero-DTE options. That's options that expire in less than 24 hours.
Wait, 0 days? People are betting on what happens in a single afternoon.
Precisely. It accounts for nearly 50% of all options volume now. It's pure speculation.
And while this gambling fuels the rally, Irons warns a massive liquidity drain is coming for the tech sector next.
So it's all fun and games until the casino runs out of chips.
According to Chris Irons, these Zero-DTE options are distorting the entire price discovery mechanism.
Right? When 50% of the volume is just day-long bets, the long-term health of the company doesn't even matter anymore. Right?
Hold on. So the stock price isn't based on how many widgets they sell, it's just based on bets?
In the short term, yes. It's a tail-wagging-the-dog situation where the options market forces the actual stocks to move.
Adam Taggart noted that this creates a gamma trap, making the market prone to sudden, violent crashes.
A gamma trap sounds like something out of a sci-fi movie. I'm guessing it's not good for my 401k.
Irons highlighted a terrifying stat. U.S. interest payments on debt have officially crossed the $1 trillion mark.
That's more than we spend on national defense. It's a mathematical death spiral if rates stay high.
$1 trillion just in interest. That's like paying for a house and never actually touching the mortgage principal.
Exactly. Chris believes the Fed is trapped. If they lower rates, inflation returns. If they keep them here, the government goes broke.
Which is why he thinks the soft landing narrative is a complete fantasy.
So we're looking at a very bumpy runway then.
Chris Irons argued that the Federal Reserve has essentially lost the plot and the public's trust.
He says they've pivoted so many times that forward guidance is now basically useless noise.
Wait, if we can't trust the Fed to tell us what they're doing, who do we trust?
Irons suggests looking at gold and hard assets. When people lose faith in the central bank, they run to things you can hold.
Adam Taggart agreed, noting that the Fed put, the idea that the Fed will always save the market, might finally be dead.
Dead? That's a strong word for the people who print the money.
Irons is calling for a major reality check. He expects a correction of 20 to 30%.
He argues that once the liquidity from the reverse repo market dries up, there's nothing left to support these valuations.
30%? That's not a correction. That's a sell my car level event.
It sounds extreme, but Chris notes that many stocks are already down that much. It's just being hidden by a few tech giants.
So the Magnificent Seven are basically the only thing holding up the ceiling.
I really hope those 7 guys are feeling strong today.
On the brighter side, Irons is incredibly bullish on gold and silver.
He sees gold hitting new all-time highs as the global de-dollarization trend accelerates.
Wait, gold? My grandma's favorite investment is actually the smart move now?
When the digital casino crashes, people want the ultimate old-school safety net. It's the ultimate hedge against $1 trillion debt.
Chris believes we're entering a period where boring assets will outperform exciting tech by a mile.
I guess I'm going to start liking boring very quickly.
The main takeaway from Chris Irons: don't get blinded by the casino lights.
He suggests increasing your exposure to physical precious metals to protect against currency debasement.
So, buy some gold and stop checking my stock app every 5 minutes.
Basically, he's advocating for a defensive posture while the market works through this frenzy.
He also recommends watching the reverse repo facility levels. It's the hidden engine of current market liquidity.
When that hits zero, Chris expects the cocaine to wear off and the hangover to begin.
Got it. Watch the repo, hold the gold, and stay out of the digital casino. Sounds like a plan.
Exactly. Stay sharp out there. Kicking off with Michael Saylor, he laid it out there, claiming he's using market psychology to play the Bitcoin game.
Right? He views this as a strategic maneuver that places him at the center of the Bitcoin narrative. Almost like a puppet master.
So he's basically saying, look at me, while everyone else is in a panic during a sell-off.
Exactly. He's flipping the script on traditional trading tactics. Now let's turn to Nick Gerli, who's sounding off about the mortgage market.
Right. He doesn't hold back, suggesting we might be on the brink of a crisis worse than 2008.
Wow, that sounds dire. Is he saying my housing value could crash?
Yes, he is very concerned about rising delinquencies affecting homeowners. Jeff Snider offers a different lens, suggesting we're witnessing the end of an era when arbitrage was a safe bet.
And he believes that this shift will likely lead to significant financial disruptions.
Wait, so if the arbitrage game changes, aren't we all in for a roller coaster of surprises?
That's one way to look at it. Stay strapped in. What's interesting here is that despite their varying focuses, all three agree on the urgent need for vigilance in today's market.
Absolutely. Saylor talks about manipulating perceptions, Gerli about mortgage delinquencies, and Snider about liquidity.
So basically, whether it's Bitcoin or housing, we're all in a precarious boat right now.
Spot on. Everyone needs to keep their wits about them. There's also a significant overlap between Gerli and Snider. Both emphasize liquidity as a make or break factor.
Indeed, Snider believes the end of arbitrage relates directly to how liquidity is handled.
So if liquidity is tight, that affects everything, right? Even my mortgage.
Exactly. You could say liquidity works like the lifeblood of the entire financial system. Here comes the clash between Michael and Nick. Saylor is all about using market tools to his advantage.
While Nick argues that rather than manipulation, we need structural changes to address underlying issues.
Wait, so Saylor is like ride the wave, and Gerli is more like fix the wave.
Exactly. It's a fundamental ideological difference about how to approach the market. And then there's the fundamental contrast between Snider and Saylor. Jeff looks at the big picture.
Correct. He's all about macro trends, while Saylor zeroes in on how to float above those trends using savvy tactics.
So one is a broad overview, while the other is a hands-on strategy.
Exactly. They're simply approaching market analysis from different angles. If you found these insights valuable, don't forget to hit that like button and subscribe to keep up with our expert analyses.
We're dedicated to bringing you the very best in financial commentary so you don't have to dig through endless content.
Honestly, this recap made my day. In a minute, I got the gist of hours worth of discussion.
Stay tuned for our next episode where we dissect more juicy market insights. See you next time.